All right, welcome to another episode of Be the Bank. My name is Robert Height, the founder of FIXnotes, and it's my job every episode to share with you my knowledge of the secondary mortgage market, an industry that I've been a part of for over 12 years now. So today's episode is very exciting because we're talking about the state of the industry, explaining a little bit of what I learned at the most recent conference earlier this June in Nashville at the Diversified Mortgage Expo. So let's jump right into it. All right, it's episode number 58, June 2023, but a lot of this content, especially the case study at the end of this episode, is going to be relevant for a long time to come for those of you learning the secondary mortgage market. So we're going to start with this month's recap, talking about the Diversified Mortgage Expo. So this was an awesome event that really got a lot of new investors involved. One of the first things that the organizer, Nathan Turner, did was have people stand up if they're just haven't bought a loan at all before. And we went through progressively to those of us who have bought over 100 assets, or myself over 10,000 assets at this point with my career through US mortgage resolution and then FIXnotes starting when I founded this company in 2017. So let's talk about that Diversified Mortgage Expo and the optimism that surrounded the event. We had a lot of new investors involved, and I got to meet a lot of the Mortgage Note Mastermind members that I've just been communicating with online, virtually for the last 3 years. So it was awesome to meet many of you at the event. We had a great time together. But overall, I think the general gist of the event was that there is a lot of opportunity coming, and by positioning ourselves in the secondary mortgage market now, we can align ourselves to help homeowners going forward, to help banks and hedge funds unload distressed assets when we buy non-performing loans, and just position ourselves in a real estate space that is counter-cyclical to the broader real estate market. When we see prices turn down in the primary mortgage and the primary real estate market, the secondary mortgage market can allow us to capitalize while helping homeowners. So really interesting to get that perspective from some new investors that are just getting into the space. Now, on the flip side, we did have an article in the Wall Street Journal called Zombie Mortgages, and we'll pop into that article in just a minute here. But it's sort of interesting to see not only the non-performing mortgage notes really featured heavily, but the second position non-performing loans featured heavily in this very mainstream news venue. So this was that article, Zombie Mortgages Could Force Some Homeowners into Foreclosure. So homeowners say they're getting bills and foreclosure threats on second mortgages they thought they were taken care of long ago. So essentially, this article started off with these long dormant mortgages are coming back to bite. Homeowners across the country are facing these large bills on their second mortgages, and high home prices have given these investors a new incentive to try to collect. So as you can see here, a lot of homeowners are unaware, quote unquote, that these second mortgages still existed because of the charge-off process. And that is the big contention here. The charge-off process essentially writes off these loans at the bank balance sheet level, but it does not extinguish the lien. It does not release the lien from the title to the home. So this is a serious misconception on the part of a borrower to think that a charge-off, which is just the bank's way of moving those bad debts to a different part of their balance sheet, could actually mean that they are forgiven, that all the money they borrowed is just no longer owed. So essentially, this article goes on to explain a very difficult situation that a particular homeowner is in, this gentleman here, where he bought a home that his brother had built and borrowed against. His brother passed away, and then he was facing the liens that were still secured on the home. So that's an interesting situation that is a bit unlike a lot of these other potential zombie mortgage situations. And the fact that the secondary mortgage market does create this ecosystem that does, I believe, positively impact homeowners' lives by helping them resolve past debts. But it is true, the borrowers are obligated to pay what they owe. If you borrowed money, and we hear this from our borrowers all the time, they were just looking for how to make this debt good again. They're not deadbeats. They don't want to be thought of as people who wouldn't make good on the obligations. But a lot of times the charge-off process obfuscates all of the details around a loan, and they don't know who the servicer is, who the lender is, where they can negotiate to start making payments or a payoff. So in these situations, borrowers do have a bit of an uphill battle, and that's where the secondary mortgage market can help. Proactive, entrepreneurial investors who are able to communicate with these borrowers in a way that can help them get past these bad debts, can help the neighborhoods the properties are located in, the borrowers' lives, the investors that we work with, and the banks that we buy the loans from. It's a win-win-win industry. So a couple other quotes from this article. First off, I wanted to shout out Paperstack, who was mentioned in the Wall Street Journal. That's really cool to see. Now, it was in a different context here because they're essentially using Paperstack to show the fact that the individual investors are buying and selling these secondary market loans, which creates this zombie mortgage situation. But in reality, it does the opposite. It revives a zombie mortgage in a way that can be then resolved. When these loans are sitting in limbo, and we'll see a quote in a minute here, when these loans are sitting in limbo, it doesn't do anybody any good because it is a clouded title. It's a blight on the title to these homes that can essentially keep these homes from resolving in a positive way for years and years until a loan is sold into the secondary market and an entrepreneurial investor can figure it out. So this is where I think we really have some disagreements with Rohit Chopra, the CFPB director. And he essentially used the word expired second mortgages. And that is where I think a lot of the confusion comes from. The fact that borrowers think that a charge-off means their loan is expired and no longer collectible is why we're in this situation in the first place. So zombie mortgages might actually be a good term for this because a lot of these loans in limbo, which we'll see in this quote from a different article, these loans linger in limbo, neither fully paid off or foreclosed upon. They arise when a homeowner defaults on their mortgage, but the foreclosure process gets stuck or delayed for various reasons. And a lot of times it's not that they ever started the foreclosure process, it's that for the bank, going through a foreclosure, spending the legal fees and the time and the effort to take back the home, and then, by the way, dealing with the REO, the real estate owned, the property that they take back after the foreclosure has been completed, it is way more of a hassle than to charge off the loan, take the accounting relief that offers the balance sheet, and then selling that loan onto the secondary mortgage market makes more sense for them. But that's what creates that charge-off process, is what's creating these zombie mortgages that are in limbo. So when they finally are released to the secondary mortgage market, when investors get their hands on the loans and they can work with these borrowers to resolve these situations, that's where we're able to resolve the issue in the first place, to get to the root of it. So let's go on to the content that we're putting out in the next month. And that starts with our next YouTube video, quick tips on how to have success at conferences. I am fresh off of this conference at the Diversified Mortgage Expo, so I can share everything that I've learned about how to have the best possible success. And I think at this point we have 6 new members to this Mortgage Note Mastermind group, some from the conference and some from the post-conference follow-up. So that is absolutely a testament to the ability to use these conferences to grow your business. Next is our case study number 107, coming out on a non-performing senior lien that we resolved through a modification agreement. That'll be out in the third or second Wednesday of July. And then finally, our final call before the next episode to Be the Bank, the last Wednesday of July, is our Q2 2023 non-performing loan sales update. We're going to explain all of the deals that we've done in Q2 and what we've resulted from the secondary market sales we've done. So you can see what these loans are selling for and how these investors are going to then monetize these loans to help the borrowers to start cash flowing or lump sum payoffs on these assets. All right, so let's jump into assets for sale and some of what's going on with those secondary market sales. So as you can see here, the Mortgage Note Mastermind portal, this is a Podio workspace that we use to facilitate our collaboration, has almost 1,000 different opportunities for buying and selling loans in it. Now, these aren't all active at this point. Some of these have already been sold, of course, but you'll see that both members, my clients, other secondary market industry participants all have deals that come to the aggregated trade desk. My assistant goes through my inbox every single day to pull out these deals that come through, and then we release them basically like a classified ads for our Mortgage Note Mastermind members to review, to reach out to the sellers directly and pay no fees whatsoever in addition to your monthly membership to get these deals done with these different sellers. So we just wrapped up our latest sale to our members from one of my clients, and that was a non-performing cherry pick sales. So that means that we were able to sell them one-off individual cherry pick assets. And we just went to the final stage of due diligence this week, and we have 17 loans awarded to 7 different buyers. So we're able to really spread the wealth here, have a lot of buyers participate, and we're not just selling loans to the individual buyer who's able to pay the most and be able to close the entire package deal. We really like working with smaller investors to democratize the secondary mortgage market, which is the mission of FIXnotes. So let's go on to the next slide here to talk about the Mortgage Note Mastermind. Just give you the high level overview of what this offers. Of course, we've got our free course on the left here. That is how to invest in mortgage notes. And then when you join the mastermind group, you unlock access to these masterclass series. We've got the 90-day note investor, which is an accelerator course, sourcing secrets, which is basically teaching you how to find deals on the secondary market, to create your own sources of product, and bulk due diligence is how to analyze those deals. We've got all of these video courses organized into different modules to take you from 0 to 100, especially in this 90-day note investor course, to get to $1,000 a month of passive income in the secondary mortgage market. And we just released our latest masterclass course called Mortgage Note Matchmaker. And this is essentially how to become a loan sale advisory, to create these deals between buyers and sellers to make transaction fees, even if you start with $0 of investable capital. So all of these courses are available to our Mortgage Note Mastermind members, and all future courses as well are available included in the membership. So there's a lot of other things that go on in the mastermind group, like our monthly Zoom calls. We've got a ton of great recorded calls, and we do 2 sessions every single month with our expert members and guest speakers that we bring in to share different strategies and best practices in the space. So a ton of great content there. And then finally, we've got all of our different portals within the Podio workspace. So we've got a database of all the counties and states in the country. We've got our templates and calculators. We've got all sorts of documents that you can use and apply to your business. And we do all of this in our Podio workspace, which I believe is the best way to organize as your CRM platform. So not only do you have access to Podio as a member of the group, but you can also see how to use this platform to manage your investments in the secondary mortgage market or in real estate in general. I manage my rental portfolio in Podio as well. So it can be used in a lot of different ways. It's super flexible, and I believe a better option than more powerful tools like Salesforce. So I would highly recommend checking that out. And Podio is free to use for the first couple of users, even if you're not a member of the mastermind group. So even if you don't join, I think there's a ton of value there you can unlock for yourself and your business. All right, so let's talk about the case study that we did back, this was years ago now, but a non-performing second lien secured by a single family residential property that we resolved through a discounted payoff of $28,496. So the first thing we want to talk about is the metrics on this deal. The fair market value of the home was $440,000. The senior lien was $493,000, which leaves us with negative $53,000 of equity covering our second position loan. So we were owed $56,992 on the junior lien, the second position loan, that the subject asset in this case. And that means that we didn't have a lot of equity protecting us, which means also that the value of that loan, what we paid for it, was pretty low, less than 20% of the balance. So we paid $10,800 for this $56,992 debt. So we always start when we have these borrower communications with 3 questions. What happened? Where are you now? And what do you want to do? And those 3 questions help us frame our borrower's situation in a way that can then be resolved. So in this case, what happened? Well, the loan was actually sold in the midst of a borrower's property's short sale. So they were basically stuck in this zombie mortgage situation where they're then in limbo and they're not able to get the lien released because the lender had sold the asset. So at this point, the last ditch effort to avoid a bankruptcy is to sell the property again with all of the liens released, because the original short sale had completely evaporated and they needed to start over with a new property sale. So they had a buyer, actually, a new buyer ready to close on this property, but they needed all the lien holders to approve of the short sale in order to proceed. An interesting strategy in the second position asset class here is that you can actually essentially hold the short sale hostage because they cannot proceed unless all the lien holders agree. And as you can see here, we are significantly underwater. So we could be in a position where, well, we'll just wait on it. Perhaps the property will get a little bit of additional appreciation. Maybe they'll find another buyer. Worst case for us is it goes to foreclosure, the lien gets wiped out anyway, and we can essentially kind of control it from the second position debt, even if we're in a totally negative equity situation like this. Now, a bankruptcy would be a strategy on the borrower's behalf to help strip out the second lien, but we like to help our borrowers, and we were able to do that here. So we had the borrower send in all their documents proactively, their hardship letter explaining why they defaulted on the loan, the senior lien payoff quote so we could verify this balance of $493,000, the HUD settlement statement, which is essentially the document required when you sell a property to show the breakdown of all the fees, including what the realtors are paid, what all the other lien holders are paid, and what we're paid as the second position debt. And then the pay stubs or tax returns and a signed offer from the property buyer. So in this case, they wanted to sell the property for $440,000, satisfy the first lien, the second lien, and 3 judgment liens. So it's pretty crazy now that you look at this $28,000 payoff, even with all of this going on, judgment liens and a property value that's significantly less than the senior. But in these types of situations, these short sale situations, the junior lien holder can actually get the senior lien holder to take a haircut on their debt as well. So you're able as a junior lien holder to negotiate that balance down with the senior, because otherwise they have to pay the foreclosure fees and all of the time it's going to take to go through that process. So oftentimes the senior lien holder's attorneys will advise their lender to maybe negotiate this deal with the junior lien holder to just get it done, make the money now, rather than go through a long foreclosure. Now, that's kind of wishful thinking for the part of an attorney, because in their case, they're gonna get paid more if they just continue that foreclosure. But when you have in-house counsel, which a lot of these big banks that are in the senior position do, their counsel is going to advise them of the true ramifications of not getting the short sale done, the time it's going to take, the money they're going to spend, and essentially the better return that they'll have when you adjust based on the time value of money. Their internal rate of return is going to be a lot higher if they just take the cash now and negotiate a deal to pay us on our second lien. So it actually took 10 months and $415 of expenses to get to this payoff of $28,000. That included the due diligence, the onboarding with our loan servicer, and the collection process to get to this phase of the loan payoff. And a couple of takeaways here. Patience is rewarded in a seller's market. The original 6,000 short sale acceptance. So before we bought the loan, the previous lender had this under contract for a $6,000 payoff of the lien. And that's actually, I believe it's still around the HAFA allowable payoff of an owner occupied property when you pay off a second lien. It can actually be an incentive to get a $6,000 payoff. But since that was not accepted, we actually were in a better position years later. And the expiration, we held out for a 50% of UPB payoff. So $28,000 was 50% of what we were owed on this deal, and substantially more than what we paid. So it was a profitable deal, and it was rewarded because of patience. We waited till the right deal came along, and we didn't just jump in and try to get the $6,000 that the previous lender had originally gotten approved for. Now, the successful sale here for actually over $500,000. And my mistake here, the 440 was actually a little bit stronger, and that's partly why we were able to get a really strong payoff on this, was actually enough to pay off us, the 3 judgment liens and the first lien, with small haircuts on the first. And I think the judgment liens took a haircut as well, since they were junior even to our lien. And here's a good one, savor the well wishes. If you get great results with your borrowers, then you wanna make sure that you capture those testimonials. So I make sure in my Gmail, when a borrower says anything that's kind or appreciative of the process, I tag those so that we can pull them up later for the morale of the team, or maybe for marketing in the future. So in this case, we got a couple of emails after earning 196% internal rate of return. That's 10 months and doubling our money. So it's almost a 200% IRR. And here's that borrower's email, which I was really happy to see. At any rate, I wanted to thank you for being so helpful, and most of all for being so responsive when just about everybody else was not responsive in any way. This closes this chapter in my life. I'm looking forward to moving on. And he ended it with, Rob, I especially want to thank you for being so responsive throughout my ordeal selling this house. You are a rare bird. As you guys know, I love birds. So it was good to hear that from the borrower. So that wraps up our case study for today, and I do want to just throw back the call out to the website here, FIXnotes.com, where you can get our free course, the Mortgage Note Mastermind group, which will eventually cost $990 per month, and my consulting. These are the URLs, FIXnotes.com/MNM or /consult. And right now, the Mortgage Note Mastermind group is actually only $230 per month. We increased the price by $10 for every 3 new members that join. So we actually have 1 more seat left at $230 before the new price for new members is $240 per month. So definitely lock in your price at $230 by taking that last seat. And it does also offer you 50% off consulting with me. So my consulting rate is reduced for members, which pays for itself in just an hour. So highly recommend you check that out at FIXnotes.com/MNM. And if you're already a member, go on over to podio.com/FIXnotes/mastermind to get into the portal and unlock all of those resources we have available for you. So that wraps up today's episode of Be the Bank. Please tune in next month for all of our regular YouTube episodes. And then of course, industry overview, tech tips, vendor reviews, assets for sale, case studies, giveaways. We've got so much to offer here on the Be the Bank show. If you are a real estate investor, the secondary mortgage market is the place to be. Thanks again, and we'll see you next time.